Welcome, and thank you for joining us today. I'm Chris Eddy, and I head up multi-asset funds at 10x Investments. Today, we're going to be taking a look at the 10x Income AMETF, giving you insight into the strategy and how it's positioned to deliver on its outcome with low risk. I'm going to share some slides to support our discussion today. The 10x Income AMETF was the first actively managed ETF to be listed on the JSE in May this year. The fund seeks to generate a high level of income together with capital stability through investing in a wide range of fixed and floating rate instruments, both locally and globally. The fund sits in the multi-asset income category and has a benchmark of STEFI plus 1% and a return objective of CPI plus 2.5% over a rolling 3-year period. The ETF has a low management fee of 38 basis points plus VAT and an AUM of around about 690 million. The strategy, however, has about 4.4 billion invested in it as we run this in a unit trust as well as the AM ETF. The ETF has quarterly income distributions and the market maker is Jane Street. So that's a high-level overview of the strategy and some of the product details. But really, from a market perspective, the yields on offer in the market at the moment really make the current environment one of the best times to own income in more than a decade. We have two charts on the screen. The one really looks at government bond yields on the left-hand side, and the right-hand side looks at credit spreads. That would really be the spread above the government reference rate. And there are two key observations really from looking at this. Firstly, you can see that both in SA and offshore, government debt currently offers really the highest yields it's offered in more than the last 10 years. And you can see that from the pink dot, which is really at the top end of the blue bar, which is the range over the last 10 years. That's the most recent print, as at the end of October. And it's really the high government yields that are really driving the attractiveness of fixed income in this environment. Credit, on the other hand, especially local credit, but also globally, and the spreads are relatively tight. And so the bulk of the yield is really being generated by that government debt with very little enhancement from credit, where you're also actually taking additional default risk. And really, default risk is also naturally elevated when businesses have higher financing costs from the higher all-in yields that we're seeing today. So really, that government debt exposure is really providing fantastic opportunity at present. The best lens to really understand the opportunity into fixed income and where to start off is looking at the real yields available in the market. And we do this by looking at inflation-linked bonds. You can lock in CPI plus 5.2% by investing in a 10-year inflation-linked bond. And that's really a high type of return that one would typically expect either from a high equity multi-asset fund, and actually it's a higher return than what SA equities have delivered over the last 10 years. And it really creates a high hurdle against which other asset classes need to compete in inflation plus type mandates. So, I mean, for us in the income fund and the Income AMETF, we're looking to deliver an outcome over a rolling 3-year time horizon. And you know what? We can actually, at the current moment, lock in inflation plus 4.5%. So that's a real yield of 4.8% by investing in a basket of short-dated inflation-linked bonds with a duration of around about 3 years, which matches the fund. This is a really low-risk way of delivering the client outcome with a high level of certainty. So we've allocated quite a large part of our portfolio to the short-dated linker exposure. We've got about 35% of the portfolio allocated to it as a starting point. We then look to evaluate nominal bonds and see how they compare to inflation-linked bonds. And as you kind of step up from inflation-linked bonds into nominal bonds, you really are taking on inflation risk. That's kind of the additional risk that you're taking on for investing in nominal bonds. And really, we look and we try assess and see, are investors being adequately compensated for taking on that inflation risk? The chart on the left-hand side currently looks at the inflation risk premium priced into the nominal bond curve and compares that to the inflation risk premium we really achieved over the longer term from investing in nominal bonds relative to linkers. And what you can see is at the short end of the curve, the 5-year part that we've highlighted with that purple circle, really there is really no compensation for taking on inflation risk and investing in nominal bonds at that part of the curve. However, as you go further out at the 10-year and 20-year parts of the curve, there is a material inflation risk premium on offer, compensating investors for inflation risk. But the interesting part is relative to history, there's no incremental premium for investing in the long end of the curve relative to the belly of the curve, because you can see sort of the difference between the lighter blue bar and the darker blue bar is effectively the same at the 10-year part and the 20-year part. So there's really no additional premium for going further out along the curve. And that's despite, we know obviously the elevated fiscal risk associated with government finances at present. So the result of that, in terms of how we're allocating in our portfolio, is that we're really allocating to the belly of the curve from about 8 years to 16 years. And you can see that out on the chart on the right-hand side, where we're really looking to capture that inflation risk premium, but in avoiding the really long-dated part of the curve where there's no additional compensation for the risk that you're taking on at that point, and especially considering that the long end of the curve is really the most sensitive to fiscal risk. When we look at the opportunity available really from high government yields, it does create a distortion in the broader market, sort of from a crowding out perspective, because high government yields creates a problem for South African corporates. As a business, if your cost of capital is too high, you're not going to be investing in new projects. You're not going to be expanding your business. And as a result, that means you don't need to come to market and issue credit to finance these projects. And this crowding out has really created a significant demand and supply imbalance in the local SA credit market, with very little issuance coming to market. The result is that you have all of this money chasing very little credit. And what that means is it compresses those credit spreads significantly. The best example of this is if you compare the South African government recently issued a 7-year floating rate note, and it last traded in November at JIBAR plus 150 basis points. You compare that to SA bank floating rate notes of a similar term of about 7 years, and they're trading at 134 basis points above JIBAR. So you've got this extremely distorted environment where you actually have local credit trading inside government debt. So really, SA credit is unrewarded risk from our perspective. We own some of that 7-year South African government floating rate note in our fund, but we've got really little SA credit exposure. It's sitting at about 2%, because as investors, we're not being compensated for taking on that risk currently. Another lens to really look at the distortion in the local credit market is to compare it to global credit markets. We know that South Africa, as the sovereign, is rated sub-investment grade, or high yield, or junk, or kind of the other terms that get thrown around. But effectively, South Africa has a BB rating. So that means that all local issuers on a global scale are really pinned to the sovereign's rating, and BB is really effectively global high yield. If you compare the spread on offer in South African credit at around about, on average, about 120 basis points, and you compare that to global high yield at 430 and 83, well, you can see that, again, local spreads do not compensate you for the credit risk that you're taking on. And really, global credit offers materially better spreads for the same global equivalent credit rating. The other aspect is not only do local spreads not compensate you for credit risk, the local credit exposure is exceptionally concentrated, specifically when you compare that to the opportunity set available in global markets. If you exclude SOEs, municipalities, securitizations, there are only about 53 issuers in the local market, and 80% of those are concentrated in a handful of financial and real estate companies. Globally, you can invest and diversify across many issuers, across many sectors to ultimately manage that credit risk so you don't have a high concentration sitting in any one issuer or any one sector. And that's certainly how we seek to allocate to credit as an asset class. So our fund positioning really has a high allocation to SA government bonds across both those inflation linkers and nominal bonds, so kind of totaling about 65% exposure. Importantly, that inflation-linked exposure strips out inflation risk, and over the next 3 years is locking in CPI plus 4.8% in terms of that 35% of the portfolio. We're also currently sitting with maximum duration right up against our limit of 3 years, and that's primarily being driven by the exposure to the belly of the South African government bond nominal curve, as we've discussed. We have about 12% invested offshore. The bulk of that is effectively currency hedged, where you earn the spread between local base rates and offshore base rates, sitting at about 3.5%. So we're enhancing those offshore yields by about 3.5% and stripping out a lot of that currency volatility. We've got quite a high allocation to SA money markets at about 20% and a very low exposure to SA credit at about 2%. Ultimately, we're looking to really deliver the outcome in as low risk manner as possible while providing high levels of income and capital stability. Using 3-year break-even inflation as a proxy for inflation over the next 3 years, the current yield of the fund at about 9.9% is really poised to deliver real returns of about inflation plus 5.5% over the next 3 years in an exceptionally low risk manner. So in summary, the 10x AM ETF is a managed income solution, globally diversified across fixed income asset classes, all wrapped into an ETF, which is accessible on screen and listed on the JSE at a low cost. Thank you for joining us to find out more about income.